Hi, Christine. This is a very short lecture, and hopefully you watched the inventory management lecture first. One of the things that in management and also in either for your department or developing a new service, we always have to look at budgeting and break-even analysis. And from in talking to you throughout this semester, it seems like you're pretty familiar with budgets. So this is going to be kind of just a highlight, but one of the things you're going to be responsible for your final project is the development of a budget along with your financial performer. So we talked a couple weeks ago. We used healthcare pharmacy, Anytown USA, looking at their income and expense statements. And when you think about an income and expense profit loss statement, you've got your sales, your cost of goods, and then you have your operational expenses. And from your sales minus cost of goods, you have your gross margin, and that's what has to cover your operational expenses. But to be able to meet the ability to deliver your service, your business for your sales, you have to make sure to stay profitable that at the end of the year that we stayed within a some type of budget that we showed profitability. And that might not always be easy when you're first starting out a new service, especially you need startup money. There's some things you still need pharmacists, you still need inventory to meet those demands. But having a budget in place can help with those financial projections. As we know that, there are different types of budgets within different types of divisions. There's the implementation of budget planning, and budget planning is also goes hand in hand in trying to do some target marketing and forecasting. What does our sales look like for the upcoming year or the years, you know, to go into that? We have to take into potential for growth and inflation when we think about budgets. The other thing we have to think about that a budget is a financial or quantitative statement that is prepared for obtaining an objective. And that objective is to make sure that we control our expenditures, that we are under what we are bringing in revenue so that we can maintain profitability or at least a break even type of situation when we're first starting out. So the budget also is a goal for us to develop a standard of performance of what's needed to be able to deliver our service, our business. We can compare it to what is real this coming year to what we projected. We can determine what we can control and can't control. Think about this past year of COVID, all the additional costs we had to put into place for safety. And those are things that were not budgeted from the year before. The responsible person will use the budget details to determine whether the proposal is economically feasible and realistic. The budget is a means to monitor financial activities and is a way to look at are we meeting our objectives, especially of our new service we may identify and propose to implement this coming year. There are short-term budgets and long-term budgets. What I'm asking you for in your project, at least give me a 2 to 3 year budget of what that looks like, that it's going to reflect your current pro forma of what your potential sales would be. Your budget should include, what you know, your expenses for inventory are, your salaries, and any equipment or supplies. Obviously, there's different types of budgets. The income or revenue accounts is the total income must be calculated for the proper implementation of the budget. The company maintains daily, weekly, monthly, and annual costs of what it costs in terms of inventory. And true income is recording of sales of those inventory. And that will show how are we meeting our budget in terms of those sales. The other statistics that we take into account when we're developing a budget is the total number of prescriptions, the total hours of service, prescription volume per hour, per day average supply cost of medication, average salary cost per prescription. As you're looking at implementing your immunization service, what is the total number of immunizations you project for the year and in at least the next 2 to 3 years? What is the different types of immunization? What is the inventory that you may need to maintain? The good thing about vaccines, you may not always need to keep everything in stock, but vaccines don't always come sold as one individual entities. They come together, in boxes of 10. Can you divide that out somewhere within the company? Can you acquire some of that inventory maybe from the retail side? What are ways you're going to control those expenditures? The other thing is, we need to take into account our professional care of needs. So, what are the legal requirements that might be needed to meet the needs of this new service? What is the cost to deliver this service, the distribution expenses? What are some administrative and general expenditures? So, what are those expenditure accounts besides salary and wages? We have supplies, purchases, um, and also probably travel in regards to your service that you're looking to develop. So total expenditures in your budget should include your administrative, your professional, and your non-professional. These include salaries, wages, inventory, and supplies. So it's important that we try to make an estimate of what those might be. And we know those supplies can be variable based upon, the demand for the sales of the service. Is there any additional equipment you may need to purchase for that service? So if you were looking to implement, this is not talking about your vaccine program, but if I was looking to implement, a multi-dose packaging machine for adherence, I would need to, come up with a budget of what it was going to cost to purchase this product, the supplies initially for this product, and as we're going to talk about later on in these slides, what it's going to be for a break-even analysis. So the implementation of budget is a difficult task. It may require, coordinating with different departments, actually finding out, what is the percentage of my department is going to get in a budget per year. Sometimes budgets are not equal. They're usually sometimes maybe just a simple number based on the distribution of what you contributed to total sales of last year. And they may not take into account of all the different things that you need, even though they're just looking at a number. And so that's why meeting with your managers, talking about what you're doing, having a better understanding of what are your budget needs. What will you need in terms of additional manpower, additional supplies, to be able to do that. The added advantages of planning a budget, though, the sooner you can plan it, the better. Is it's a better way to financially plan, to be able to, gear resources of where they need to be prepared if we need to provide additional resources, especially for new startup type of programs. It's also a way for ourselves to be able to be more efficient with our staff and others if we have a budget to work with. Obviously, our budget is always going to be dependent upon our sales of a service and how well we manage inventory. Because once we take sales minus inventory, that is our gross margin. And our gross margin is what's going to cover all our operational expenses. If we are a service driven type of business where we don't have direct cost of goods sold, it's still going to come down to what is our sales to cover all our operational costs. In my inventory management lecture, I talk about ways to control inventory, but inventory is probably the key one to help control costs. The two most expensive things in any type of pharmacy service or business is wages, pharmacist wages, and inventory. And in the inventory world, we need to make sure we have enough drug in stock, make sure we're not wasting due to short dating, and to avoid shortages. In terms of your immunization program, think about that. Some of these vaccines may have short dating. Some of these vaccines, you want to make sure we're not wasting anything because of that short dating. Some of these vaccines, we may not be out of stock because we can plan ahead. However, we may be, have to order in bulks of 10 or bulks of 20. We may not be able to order individuals for that situation. As I said, cost of goods, inventory is important, but because that drives gross margin. But when we look at total expenses, these are the things we think about in terms of our budget. salaries, rent, utilities, legal fees, taxes, licenses, insurances, interest paid. And there's different people that may be responsible for all these different things. So, for example, for an independent entrepreneur who owns their own business, they may need to renegotiate the lease every so often. They may need to bid out their utilities and look at, are there other opportunities besides just one type of internet provider. Looking at bidding out your insurances, looking at when you purchase a large product that can depreciate over time, like computers, equipments, you know getting the best priced for that, and what can you depreciate or what can you write off on taxes that given year. But break even analysis, and I provided you a chapter for that. I'm just going to highlight this and we'll talk about this. Break even analysis is looking at what are your total costs, all right, and what is it going to take to when we reach sales that we're going to cover those total costs, which can include fixed costs and variable costs. So the purpose of even analysis is to find when the total revenue equals total cost. So when you're projecting and wanting to sell a new service or a new business to investors, you need to show, when will I break even? When will I be able to, you know, cover my expenses, which can include maybe my debt of a loan, and start seeing profitability. Most retail environments, startup pharmacies, prior to to maybe a couple of years ago, the reach for profitability was anywhere from 18 to 24 months. So we needed to have enough, you know, capital line of credit to help cover us during that time period. If you're just starting out a new service and maybe it's within your own company, how much time can I budget? How much salary can I budget to this new service to be able to cover it before it stands alone within my department? And so break even analysis helps play that role. I gave you this week in the module a simple Excel spreadsheet that takes a look at break even analysis. And so if you think about the key components for break even analysis, it's your total revenue, it's the total volume of what you're going to do in this service, and then you have some of your fixed costs, which could be your rent, your computer expenses, utilities, business insurance, auto bill costs. And then you have your variable costs, such as your supplies, all right, delivery service, postage. And you need to determine, this can help you with your budget of what I can budget towards this, and what do I need to get till I see that break even analysis, or I see that I am making profit in my service. So if we're analyzing on a single product, we can take the average prescription price, which is the RX sales divided by the RX dispensed. All right. We can take the total revenue, which is RX volume times the average RX price. And, so we can look at, all right, what is it going to take? How much are we going to have to do to be able to hit that break even? So if we're analyzing on multiple products, we need to look at that contribution margin, which we talked about in our differential analysis. And so we would look at revenue minus variable costs, that is our contribution margin. And the contribution margin as a percent of sales is used to help calculate, the pharmacy's break even point. And so we then minus fixed costs equals net income. So if you take a look at this pharmacy, the revenue is 892,000. The variable cost is 643,000. So we have 248,000. All right, is our contribution margin minus our fixed costs, which is our net income. So if we take that 892,000, all right, in sales minus our variable costs over sales, our contribution margin is 27.9% of this product. When a pharmacist manager wants to make additional changes, they're going to look at this deviation of fixed costs, all right, and minus that looking at that contribution, fixed cost plus net income over contribution margin. And we can see that, for us to be able to stay even, we have to do about 36,120 prescriptions to be able to add with this contribution margin. If we think about if we wanted to analyze increasing advertising, so for example, say the manager wants to increase the advertising budget by $500 per month. So we take the sales volume before, which was 892,000. The contribution margin is 27, 27%. The fixed cost was 207, and we knew our net income was 4,400. If we increase advertising, this will only affect our fixed costs, which will increase by $6,000. So we take 500 times 12 months. And so if we look at this, to be able to see this break even point, all right, we need to do in sales 912,093. All right. So if sales would increase less than 20,000, the profits would decrease. So we need to, this shows, okay, what would it take if we added this additional cost? Another is analyzing increase in RX volume to cover advertising. So for example, if we increase prescription advertising by $250 per year, which is 3,000 per year, and our RX volume was 36,100 per RX, and our contribution margin was $5.18. Our fixed cost was 181,000, and our net income was 2,000. Then we would need 598 prescriptions per year to be able to cover this increase, to help cover this advertising costs. And the goal of why we do these types of break-even analysis is so that we can see what benefits would we get if we added this. So obviously, I doubt if you'll be able to do this, Christina, but if you had the ability to look at what are the additional costs and sales of adding your service compared to what your current sales and your net income is, you could look at what you would need to be able to reach break-even analysis under your current operational costs. Another analyzing is of looking at break-even analysis is looking at profitability. So for example, if we had a 10% discount on an over the counter, and so 25 of total sales is OTC, so 2.5% on all sales discount. All right. So if 25% of all sales and we're going to discount by 10%, there's going to be 2.5% on all sales discounted. So if we took our sales, which was 869,700 times 2.5, all right, and we know our contribution margin would be 26%. So our being able to break even would be around, we would have to see sales in the amount of 956,538. I will go over the break-even analysis when we meet live. Please read through that chapter and we'll go into more detail about it. I think it's a little bit more complex talking about it in a video versus talking about it in person, but I want to use your case scenario of that. So what I'd like you to do, if you're able to, when we meet live, is take a look at what your current projections are for year one, year two, year three, you think of sales could be. And actually, if you just got the first year, that would be fine. And what you would want to do for year two, year three, show that you're going to do at least maybe a 5% growth. Okay. If you have any questions, feel free to give me a call. Thank you.